What is going on? Welcome to my channel. I am the covered call guy. My goal is to create $120,000 per year passive income portfolio using only covered call ETFs. Right now, my portfolio yields me about $72,000 a year, $6,000 a month, about $1,400 a week, and almost $200 per day. The goal for 2025 that ends in about a week and a half is to hit or cross $75,000. So going into 2026, fingers crossed, knock on wood, I hope I reach or hit $75,000 per year. I will be updating these at the end of every month, so you'll get to see my progress at the end of every month. Hopefully, right, I'm adding at least I'm hoping $1,000 per month increase. I don't know. That's what I would like. So um, maybe I'll reach my $120,000 goal within 2, maybe 3 years. All right. Legal disclaimer before we start this video. This content is for informational and educational purposes only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. Please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions because remember, I am just some random idiot you found on YouTube and I could be completely wrong. Now with that out the way, let's get started on the video. It's going to be on 3 ETFs or uh, I IDVO. I'm just gonna say IDVO, NVIT and TESS, right? So we're gonna do a comprehensive analysis versus the core versus satellite portfolio strategy, and this was requested from the comment section. So again, guys, leave your request in the comment section. If I don't get to it, I apologize because just with the channel growing, I am getting a lot more comments and I can only spend maybe 20, 30, maybe 40 minutes sifting through the comments and I'm trying to reply to everybody. And some days I can only look at it for 5, 10 minutes before I have to go and do something else and or start the next day for whatever it is, right? So I hope you guys understand. I'm not ignoring you guys. If I don't reply to you for multiple videos, it's just sometimes it gets lost. So don't give up. It is not spam. 100% go ahead and leave your comments for the request. I will do my best to reply to all. All right. For IDVO, I don't know if I did a full deep dive, but I do have a video on it November 14th. I think I did a partial breakdown, but hopefully this video will be a kind of a part 1.1.5, part 2. Hopefully I have done a better job. As every video I put out, I try to make it better and better with more information, more scenarios, more my take, just more information as much as possible. All right, enough talking. Let's get started. All right, the core satellite income mandate, right? So I'm going to split it into two. The contemporary income ETF landscape has bifurcated into two distinct categories, at least I think so. One is the strategic quality, right? Assets designed for long-term compounding. And the second half, structural volatility. Instruments designed to harvest option premium. So this is my quote unquote my full deep dive because it is split into three uh, ETFs we're looking at. So I might not be able to get a real full picture just because I'm trying to not make each one 20-30 minutes, right? This would be a 2 hour long video. So I try to compress as much as I could, just the facts, just what we need. All right, so we're going to be comparing IDVO from Amplified CWP International Enhanced Dividend Income ETF against the newly launched YieldMax Target 25 series, right? NVIT, Nvidia, and TESS for Tesla. So I just want to put it out there. I try to be non-biased, but if you're new, I am a big fan of Amplified. I think they are great. I think they have great stocks and ETFs. I'm not going to go ahead and lie to you. I used to have a big position in IDVO. The reason I say used to is because all I did was move that amount into QDVO. I'm probably going to get back to IDVO at some point once I start scaling out my portfolio again. But yes, I'm going to go and put that out there that I really do love the Amplified funds. So let's get started on how I feel about the new YieldMax. Alright, so the investment thesis for this video, right? I'm going to go ahead and say IDVO is the core anchor. Out of the three, I'm going to label this as the core anchor. To me, it is a sleep well at night holding. It utilizes active management to select high quality international equities, right? And applies a tactical cover call strategy, which Amplify uses a lot and most of, and if not all of their holdings. So this strategy, it aims to preserve upside participation while dampening volatility, right? The fit for this would be substantial allocations. I would say anywhere from 15 to 20% because it is a core. It's supposed to hold your portfolio down, right? It's supposed to be a rock. It's supposed to solidify your portfolio and you build around it, right? And conservative to moderate portfolios. Now these two from YieldMax, NVIT and TESS, I would treat them as a tactical satellite. Why? Because at the moment, one, they're very, very new. Two, I'm not being a hater, okay? I am not being a hater. I just want to put this out there. YieldMax has a lot of proving to do. Just because they have one or two or maybe three stocks that is performing well does not mean the other 97 gets off the books, gets off the hook because of that. They have a lot of proving to do. So with that, I did sprinkle a little bit of that perception onto my analysis. Now, I don't know how you feel about that, but when I do my deep dives, I like to feel a little anxious and suspect of everything. You know, I like to put as much of the beautiful and the ugly, and then I'll look at the middle ground. So that's what I try to do. Now, if you feel like I've been a little bit biased, there are reasons why for it, right? I don't want people to get into YieldMax and get burned. There are plenty of horror stories. You can just go in and just Google it and find plenty. There are a lot of them out there. Even on YouTube, plenty of people talk about getting burned. So this channel is all about preserving your wealth, compounding your wealth. I do not want you to lose money. Alright, so I'm going to treat this as a tactical satellite. It is a high-octane trading tool. Alright, I'm going to label these as Gen 2 derivative funds. Right, they solve the capped upside flaws of the predecessors of NVDY and TSLY by using credit call spreads to target a 25% annualized yield. How I would fit this into my portfolio? Small, active allocations. No more than 5%, right? They have to prove themselves, right? Where the investor understands the trade-off, right? So where you have to understand. Also, I want to mention this. The reason these two were created was because people were complaining that every other fund they had was basically eroding to the ground. So people were saying, if you want our money, you're going to have to actually give us a good product. And what that means is bringing that 100, 110, 90, 80, 70, 60, 50, even 40% yields down to the low 30s, down to the low 20s. All right? Because the market will turn on you with these high yields. That is the reason why these funds were created. They were created because YieldMax, essentially, they didn't obviously publicly say it, but you can kind of guess that they were admitting that, you know, one of the most popular fund, OT, was failing, right? With the stock split and all that other stuff. Essentially, they're admitting that. At least the way I view it. So if you can view it through my lens, you would see why they created these funds. Right? The core anchor. Let's talk about Amplified CWP International, IDVO. The fund architecture and enhanced strategy. Unlike passive buy-right ETFs that mechanically sell calls on entire index funds every month, IDVO operates as an active tactical strategy. and that's why I put it in quotes enhance, right? Um, it might not always be enhanced, but that's what they're claiming with this strategy, right? So they use an active stock selection. The managers have a high conviction, where you also need a high conviction in the manager's pick. A portfolio of about 50 to 80 international companies. So it's quite diversified in my opinion. They are targeting dividend aristocrats, which is very, very good. Right? I can sleep. That is why I put it as a sleep well at night. Dividend aristocrats are typically the ones that have a moat. They've been doing this for decades. They've been probably doing this for longer than you and I have been alive, right? Paying out these dividends and growing them, right? Targeting dividend aristocrats characteristics, which just means strong, free cash flow, low debt, and dividend growth. The three trifecta, right? And then on top of that, they just play a tactical option overlay, right? So kind of what Devo's doing, right? So crucially, CWP does not write calls on the entire portfolio. Calls are written on individual stocks only when technical suggest they are overbought. So what does that mean? That means they are growth first and then income. So as long as you understand that trade-off, they are here to grow your NAV, your capital appreciation, your principal. And then on top of that, say, hey, look, it's been a great month. We wrote some calls. Here's some additional income. All right. So some months they might go, you know what? We didn't really feel like writing calls today or this month or whatever, they feel like. We're just going to let the market ride it out, and you might get some capital appreciation with a little sprinkle of dividends from the dividend aristocrats. So just understand that. That is the trade-off here. In my opinion, great strategy. Why? I bought YieldMax for that reason. All right, IDVO's double income stream, like I mentioned, right? So they have organic dividends. Whether they write the options or not, they are getting organic dividends, right? Around 3 to 4% target from underlying corporate cash flows. And then on top of that, they try to make it a little juicier with the option premiums. They target 2 to 4% target from volatility harvesting. The result, a target total annual income of about 5 to 6% paid monthly with lower volatility than the broad market. So yes, it is not the highest yield. However, this is a hold. If it was in my portfolio, this is a hold forever and to pass down to my kids. I'm going to go ahead and just, I don't even have to worry about this. If I had $500,000 or $1,000,000 in this, I would not need to worry, because 5 to 6% is 100% sustainable in any type of market, I believe. Go ahead and come back in like a year, and if I'm wrong on that, then the market's gone insane. But 5 to 6%, very, very sustainable, especially how they're playing the game here. Very sustainable. That is why I said it is a sleep well at night holding. Right? So you buy this to sleep well at night for international exposure. All right, let's talk about the portfolio composition and exposure. All right, IDVO provides critical diversification away from U.S.-centric tech-heavy S&P 500. It invests primarily in ADRs, simplifying liquidity and custody. Their top holdings is global heavyweights such as Alibaba from China, Taiwan Semiconductor (TSM), Novartis from NVS, Barclays, BCS, and Sumitomo Mitsu SMFG. And I should probably put ADRs, what they are. It's basically a certificate that represents shares of a non-U.S. company. So obviously you can see here, this is international, right? So you're buying non-U.S. companies, so they just need to ADRs allow U.S. investors to buy, sell, hold stocks in foreign companies on the American stock exchange, like the New York Stock Exchange or the Nasdaq. So that's what it means, and nothing, no red flags. you need ADRs when it comes to non-US companies. All right, IDVO's key metrics. Okay, sectors allocation: finance, about 22% of it goes to global banking. Consumer discretionary is about 16%. Chinese recovery via Alibaba, and then material and energies, inflation hedge, right? Southern copper, performance and risk. The beta is 0.73. That just means it's 20% less volatile because we use 1 as the metric, right? So anything below 1 is less volatile. Anything at 1 goes 1 for 1 up and down. Anything over 1, it means it is more volatile than your standard SPY, QQQ, and whatever metrics you're using. The valuation is about 13.85x to 18.8, right? So it has a value cushion. The yield is anywhere from 5.3 to 5.9, sometimes a little bit higher, paid monthly. All right, let's talk about the YieldMax, the tactical satellites here. At least that's how I would play it if I were to own these three. Let's talk about YieldMax Target 25 of NVIT, Nvidia, and Test for Tesla. They both launched in November 2025. These represent a structural evolution in single stock ETFs. What they do, as at least what they're claiming to do, is that they're aiming to fix the capital erosion issues plaguing generation funds like NVDY and TSLY. Now, again, I am not bashing them on any way. For one, it is very new. It literally launched less than 30 days ago, maybe 2.5, 3 weeks ago. So they don't have a full month. Okay. So what information you're seeing here is because I'm basing it off of one, they're very new, not even 30 days in yet. Two, I am basing them off of how YieldMax as a whole has been performing. And three, basically they're not admitting, but they are admitting here that they aim to fix the capital erosion plaguing YieldMax, basically almost all of the holdings, right? So I am a little harsh on them in this video just because we should be, right? It is your money, so you should be harsh. You work hard for your money. Why would you want to give it away for free or just lose it like that, right? So, investing in YieldMax right now is essentially probably even worse than the lotteries, right? So, I mean, at least the Powerball is like 1.5 billion, and you might even have a chance, even though it's 1 in 20 million. I don't know. But what I'm saying here is I'm not bashing YieldMax. I just have a harsher stance just because of what I mentioned earlier. All right, structural innovation, the credit call spreads. Now I say structural innovation because YieldMax typically don't do this. All right, so it's structural innovation to them. All right, Neos has been doing this and been playing the game very, very well. Amplified has been catching on, and I believe Roundhill is also starting to catch on. So it's structural innovation to YieldMax. So let's talk about the problem of Gen 1, right? Funds sold naked calls. If Nvidia rallied 20% in a month, the fund was capped at 2 to 3%, missing the rally entirely while still taking all the downside risks. This led to long-term NAV erosion. As you can see, on almost probably like 90% of what they released has NAV erosion, right? So their solution is to use the Gen 2 method, right? Funds deploy a credit call spread strategy, sell call, which is the short leg, generate incomes. That's the whole point of that sell call, is to generate that income. And then they buy a higher call, which is the long leg. Right? Costs money, but uncaps the upside. Again, if it gets capped out, you still let your NAV grow, your capital appreciation grow, and you still collect some money. So that's okay. That's fine. The mechanism and the trade-off, right? Mechanism here is the stock melts up past the second strike price. The long call kicks in, allowing the fund to participate in the rally depending on how much they bought up. Typically, I say they do no more than 5%. The trade-off, buying the long leg reduces net income. This is why these funds target 25% annualized yield rather than the 100% plus yields and of Gen 1, right? The sacrifice, they sacrifice yield sustainability for NAV growth capability, which if they can hit these target 25% without NAV erosion, it would be extremely, extremely good, right? That would keep me watching them very closely. So I would say if it's in your portfolio on the watch list, or if you already own it, definitely don't make it a huge portion, but keep your eyes on it. Give it at the end of the third month, I would say see how it performs, but really give them at least 6 months to see, because you can't really judge a ETF or stock with that little historical data and without actually experiencing some uh, bull market, bear market, and a choppy market, right? You have to see how it actually performs. You have to see how they actually execute their strategies and if they're holding up to their prospectus. All right, institutional warning. That just means liquidity and execution, right? So unlike their massive peers with over 800 million asset under management, NVIT and TEST are currently microscopic, right? Creating significant execution risk. And what I mean by that is the low, because one, it's new, so they have very, very small assets under management. The daily volume is under 5,000 shares, which means their bid-ask spread is extremely wide. Why do you care about that? Well, because the lower the bid-ask spread, the higher the profit is. And because they don't have a lot of money to play around with, they have to make sure they don't get called away. If they do, then they lose even more money, right? The whole point is to not get called away. That way you collect and you just pretty much recycle, right? And you're paying a lot more money, and I mean by you, not you, the fund manager is, right? So yeah, you have to be aware of that. Not a lot of people think about that. We don't see it because if you were to buy a stock or play the call options yourself, I'm not saying you don't have a lot of money. Perhaps you do. Perhaps you play 10, 20, 50, $100,000 at once. That is nothing to these funds, right? These funds play in the millions, and depending on how big they are, and like NVIDIA, they play in the billions, right? So you can see here, like 0.30 to 0.50% more. So let's just say 10 to 30 cents more per bid. So you can see multi-millionaires, multi-billionaire plays, they're eating away at their costs. And then for execution, I would say put a limit order compared to, if you were to hold the others. My warning here, as we're coming, we're talking about all three. Due to low volume, the bid-ask spread on NVIT and TEST can be 0.50 or wider. Buying and selling immediately using market orders can cost you 1% of your capital, equivalent to 2 weeks of distribution. Just keep that in mind. Right, taxation and ROC realities, right? Unlike IDVO, distribution from NIT and TEST are largely derived from option premiums and synthetic positions. Ordinary income, right now I don't think they qualify for favorable QDI rates. It just means qualified dividend income. I think they're going to be taxed as ordinary income up to 30% federal plus state, depending on how much you make. I don't think they have Section 1256. Options on single stocks do not qualify for 60/40 tax split. Tax entirely as short-term capital gains. So let's factor those in too, right? You're eating away at your gains. All right, ROC risk. Recent distributions show 94 to 97% return on capital. If not, NAV is flat or dropping. This is destructive ROC, literally handing you back your own money plus the taxes you have to pay on it. All right, scenario, right? So this is, of course, my scenario, my opinion, my guesstimate. So in a scenario of a bull market, underlying plus 20%, IDVO, which is your core, would probably capture at least, would it go up at least 15 to 18%, captures at least 80 to 9% of upside due to low call coverage. NVIT, and TEST, I would say they would do even better in a bull market, probably increasing by 30 to 35%. The spreads allow NAV to grow plus the 25% yield versus the Gen 1, right? Obviously, the Gen 1 loses here. And then the melt up, underlying plus 50%. IDVO, your core, I would say increase anywhere from 35 to 40%. Full participation, right? Calls stopped. For NVIT and TESS, I would say it will go up to anywhere from 45 to 55%. Long call legs, uncapped upside. And of course, compared to Gen 1, severely capped, massive underperformance. The scenario for a flat or bear market in a flat or choppy market where the underlying plus or minus 5%, IDVO will either plus 5 to plus 8, dividends plus premiums offset stagnation. NVIT and TESS, I would say anywhere plus 20 to plus 25. Yield is realized, NAV stay flats, while the Gen 1 outperforms due to higher naked premiums, right, in the money calls. In the bear market, underlying drops 20%. IDVO would probably drop anywhere from 12 to 15, right? Defensive stock and premiums cushion the fall. NVIT and TESS here drops 15 to 20%. I would say it falls one-on-one with the stock. And then, of course, Gen 1 would drop anywhere from 10 to 15 because the high premiums provide the best buffer. So you do have some cushion here. So here in the bear market, NVIT and TESS loses because it goes one. At least I think it would fall 1-for-1 with the stock underlying. All right, strategic recommendation, the core allocation. In my opinion, out of the three, right, IDVO should hold anywhere from 15 to 20% of the portfolio. At least I would have that as 15 to 20%. The role here is portfolio ballast and income generator. Why? International diversification, right? Undervalued versus US right now. Tax efficient income will qualify dividend income and institutional grade active management. They have been performing so well. Amplify has been doing great. It has historically captures upside while reducing drawdown debt. The action: buy, hold in a taxable or tax advantage account, reinvest dividends. Unless you're actually ready to retire. Strategic recommendation for the satellite allocation, NVIT and TESS. I would say no more than 2 to 5% of the portfolio. The role here is tactical income booster and pure speculation. Why? Use these instead of NVDY or TSLY if you're genuinely bullish on Nvidia or Tesla but want fast cash flow. The strict limits is due to low asset under management. Never use market orders. Try to keep as much money as you can. Tax location. I mean, if you have an IRA or Roth, this would be the best in it. But if you have a taxable brokerage, then obviously that works too. You're trying to live off of it. And then, of course, monitor the ROC, right? If ROC is over 90% while the NAV is dropping, strategy is failing, get out. Run. Don't stay. You're going to get burned. All right, summaries of competitors, right? For the income maximizers, right? Misty and NVDY. If you ignore NAV erosion and only want cash flow, higher yields from 50 to 100%, but higher capital risk. For the bullish speculators, NVDL at 2x leverage. If you want maximum capital appreciation, superior in a bull market, though pays no yield. Balance and growth. NVIT and TESS, I think that's at least I put balance and growth because that's what they're trying to aim for here. So these two would be the best for that. We don't have no historical data. That's what I believe that's what YieldMax perspectives of these two is aiming for. All right, so they occupy the sweet spot, which I put in quotes because it is new and it is YieldMax. Right, it's a sweet spot for investors who want high income at 25% yield, but refuse to sacrifice the future growth of the stock. So these two would be at least what they're claiming to be the sweet spot of trying to have both. And my verdict, right? IDVO, the Amplified International Enhanced Dividend Income. My verdict is a strong buy. At least I would buy it. It's a core holding. My role is defensive income generating for portfolios, 15 to 20% allocation. My bottom line here for this: excellent long-term income focused anchor with international diversification with downside protection. Strength versus cautions, okay? We all talk about the beauty, nobody talk about the ugly. The beauty of the strength is active selection. Of course, you have to have high conviction, tactical overlay, strong risk adjusted profile, tax efficient. The caution here, slightly higher expense ratio at 0.66, modest upside cap. So understand the trade-off. And then NVIT, YieldMax Target 25. My verdict is high yield tactical play. The role, satellite allocation for yield and tactical exposure under 5%. The bottom line, suitable as a small tactical satellite for high risk, high income objectives, but not a core holding, at least not right now. They have a long way to prove themselves. Strengths versus caution. Strength, credit cost spreads, uncapped upside. They target 25%. If they aim and get it without NAV erosion, that is a huge strength. The caution, right now, of course, like I've mentioned multiple times, extremely low liquidity, high ROC risk. Right now, it does. Ordinary income tax. And then test from YieldMax Target 25 for Tesla. My verdict here is the same. High risk tactical satellite. The row, satellite tool for tactical explosion income under 5% of the portfolio. My bottom line here is use it as a tactical satellite for small allocations, only for investors who understand ROC risk and single stock exposure. The strength versus caution here. The strength, credit call spreads allow participation in rallies. However, like I said with the other one, same issue, very low liquidity, high ROC risk, right? Single stock concentration. If they're paying out 90% with the NAV going down and the underlying is going up, we have a major issue here. Right, so IDVO is the core reliable income generator, while NVIT and TEST are high risk, high income tactical satellites suitable only for small, actively managed allocations. As long as you understand that, you are in good hands. All right, thanks for watching. If you enjoyed this deep dive, I hope you did. I hope it was educational. I hope it was informative. I hope it was fun for you to watch. I know this was quite a long video. I try to compress it for as little as possible, but with all my yapping from the beginning till now, it went over a little over 30 minutes. If you liked it, please subscribe, comment, like. And again, for those who I haven't responded to, I have not forgotten about you. I promise. I'm sorry. Leave your comments again in all of the videos being posted. I will do my best to answer you. I promise you that. Thanks for watching, guys. Stay tuned. Catch you guys on the next.